Hello, I'm Felicia Jackson.
And I am Giulia Buttaro.
Welcome to Shake and Not Burn. Every day we're bombarded with headlines of crisis and disruption, from climate shocks to inequality to AI upheaval.
But behind the noise are choices, patterns, and opportunities. What we need is sustainability literacy, the clarity and confidence to interpret complexity, see trade-offs, and make decisions.
Our podcast goes beyond the headlines to uncover how real people are tackling change and what we can learn from them.
You can use these ideas to stay steady, even unshakable, in a world that feels uncertain.
This is Shaken Not Burned. Hello and welcome back to the latest episode of Shaken Not Burned. You know that feeling when you realise that the world is on fire and then someone tells you that the solution is a financial instrument? Yeah, that sounds a little bit confusing. Today, though, on Shaken Not Burned, we're talking to someone who actually made that sentence make sense. So Sean Kidney is the co-founder and CEO of the Climate Bonds Initiative, the group that helped turn a tiny niche idea into a multi-trillion-dollar global market for green and climate bonds. He advises governments and central banks and regulators all around the world on how to move money where it actually matters. So he's basically the guy you call when you want the rules of finance to stop being part of the problem. But this isn't just a conversation about taxonomy footnotes or EU regulations, section whatever. This is about how we can steer capital in a world that is already in crisis, about who gets left out, what counts as green, where the legitimacy of the whole system is under strain. So we're going to talk about the myths, the politics, and the emotional reality of working on climate finance at a global scale, and why the future of resilience might depend less on clever instruments and more on whether or not we can keep trust from collapsing. So Sean, first of all, welcome to the show.
Hey, thanks for having me on, Felicia.
Absolute pleasure. Now, the first question I have to ask you really is, when did you realise, when did it hit you that the old models for debt and equity weren't really going to cut it for what we needed with climate finance, and that, we needed things to operate in a different way?
Well, it wasn't so much about the fact that finance had to change. It was about how the world needed to change. Climate change is essentially a tragedy of the long term with decisions made for the short term instead. And this is crazy, right? When we have extremely clear science saying what we need to do. I mean, it's a bit like that bridge is going to collapse on 12 o'clock on Sunday afternoon. Get ready. We would act, but no, for climate change of similar levels of certainty, we're not acting. And what is going on? Well, clearly what we have is a whole lot of interests, short-term focus interests, stopping long-term action. I mean, the classic Exxon board case of 1984, for example, with the clear advice about what was going to happen, which has been pretty well spot on with the development of climate impact since then, and the board ignoring it because it would compromise profits over the next few years. And that's pretty well everywhere. So we have a structural problem in how we construct our economy and society. So what do you do in those circumstances? And I remember speaking to a friend of mine who was a treasurer of a provincial state government who said, Sean, for every person who talks about climate change to me, I get about 40 talking about fossil fuels. What do you think I'm going to do? Fairly good point. So it turns out, when you poke around, that there's a class of institutions that actually have a mandated long-term obligation to match, in their cases, assets and liabilities over the 20 and 30 and 40-year term.
Pension funds and things like that.
And guess what? They own the planet. There's 150 trillion of them. It's unbelievable. They're like a sleeping elephant. In the meantime, decisions are being made on a day-by-day basis which are directly contrary to the interests they represent to ensure that your pension can be paid when you finally retire in 2045. And that really does require a change of thinking. So the whole premise for Aaron was saying, hang on, we need to bring different actors to bear if we're going to have different decisions made. And where do you look? And the experience I had in the 90s working at pension funds in Australia was that they're a very interesting new body we've created over the last 40 years, which have the potential to be highly influential in the interests of the next generation, in the interests of the future. And that's really what it's about. So the instrument is related to what that particular class of investors need. They happen to be overweight in in bonds because they're trying to match assets and liabilities. So they like a 20-year bond that pays out in 20 years' time when they have to pay your pension when you retire, et cetera, et cetera. And if you're not talking bonds, you're not in the room.
So this was something that you knew about from your previous work, and you identified the fact that there was this interest. So how did you go about actually creating a mechanism that was specifically aimed at climate?
Well, the first part of the conversation was engagement with asset owners, pension funds and insurance funds about the challenge. And that had been started already. The reinsurance industry had been engaged in the 90s, initially by a guy I'm now proud to call a friend, Jeremy Leggett, when he was Greenpeace's climate change campaigner, some 40 years ago, 35 years ago. And that worked. Swiss Re spoke at the Earth Summit, and I think it was in Berlin in 1996, for example. But that didn't mean the asset management side of the businesses were engaged, because they were generally speaking, or rather looking 5-year out. Their modern portfolio management theory was not very well equipped for long-term investing and long-term recalibration of portfolios. So first talking to investors saying, you've got a problem, there's an issue here. Yes, we get it. And that's pretty common, by the way, across the asset owner insurance sector. Hey, we've got a problem. Look, they're full of actuaries. They read the science.
Yeah.
And they understand the numbers. So there's no real doubt about it. What do we do about it? So we decided, look, the first thing you can do is to start switching your investments where you can with no loss to the short term, but bias towards climate-related investments. So we started doing reports, educating about that. And we came across an instrument that had been developed by two development banks, the European Investment Bank and the World Bank, called a climate awareness bond or green bond on the other side. Basically, they'd done it to get some new investors from Scandinavia in, and it worked. Okay. And this looked like it was interesting. So we started encouraging people to issue more. Development banks issued more. And we managed to establish, with the help of the Treasury IFC, actually, part of the World Bank in 2013, that these were things that were attractive to investors, because we had all these investors out there that worried about climate change. What we did is we gave them a bond that was the similar risk yield to an ordinary bond, but had a bonus feature, is that it addressed the worries of actuaries about the long term. So it was win-win. It dealt with short term and long term. And at that point, every investor said, of course, I'm going to get, why wouldn't I buy that?
Now, you see, that seems incredibly logical. But one of the things I don't really understand is, how does it address immediate need for return as well as the long-term need for return?
It all depends on who's issuing the bonds.
Okay.
So
whether it's a
company
or a city or something like that.
Yeah. Like, you're not going to get a project developer developing a solar farm in backwoods Surrey doing a small bond that's going to be relevant because they can't do bonds anyway. They've got to get a bank loan or private equity to do it. The normal laws of risk still apply. Okay. But if you have a bias towards climate investors within your risk calibration, actually, there's a lot you can do. It does mean you're going to be looking for bonds issued by banks, by big corporations, by governments, which is what we have now in the globally. The market's grown from $2 billion when we started to now $6 trillion outstanding. Because we managed to get large organizations to issue, and that provides an internal incentive to do more. I can remember when one of the first corporate issuers of green bonds was a company now called Engie, which was a gas company that had solar and other investments in renewable energy. And I was sitting next to the Middle Eastern head of Engie on a panel in Dubai. And he turned around to me and said, this green bond in head office is such a pain. And I said, so why is that? Sounds like a good idea to me. He said, because they keep telling us we've got to do more green stuff. And I thought, bingo, that's a success.
And that's
exactly
what
they've been saying.
That's exactly what it was supposed to drive. So can you tell me the sorts of things that get invested in? For some of our audience, they're not going to know the details of finance. We know the basics of the difference between equity and debt. But what is a bond useful for? What is it used to finance?
Well, bonds are mainly used by entities that make loans or make investments and then refinance those in the open market. So a corporation, for example, a corporation is simply an engine to take a whole lot of risk and then to refinance in the wholesale market. They typically expect like a 20% internal rate of return. They invest in a solar farm, they want 20% return. And then when they've got the asset, they then issue bonds, of course, corporate balance sheet with the asset on it at 4%. And they basically make money on the arbitrage between the two. And that's what banks do as well.
So basically, we're using a system that is completely established that everybody understands. We're just using it to funnel money towards things that we hope will improve the climate. So I suppose that then begs the question. You mentioned that the market had gone from 2 billion to trillions today. So does that growth, is it growing the same every year? Is it accelerating? Does it mean we're really moving capital towards climate action, be that mitigation or adaptation? Or, is it a comforting number that's just kind of hiding the fact that even more money is going elsewhere?
Look, it's helped a lot to get more capital flowing to folks that are investing in the right kind of investments. That's one point. It has, because we've now got cheaper bonds if they're green and climate, it helps slightly reduce the cost of capital. I mean, to give you an example, when the UK government issued its first sovereign government green bond for 10 billion sterling, they saved £28 million for the taxpayer by calling it green and making sure the proceeds only went to green. And that's quite a common story. That's a nice story.
So the interest rates are lower because it's green?
Correct. Now, there's a story why I go into. It's not because of sentiment. People aren't doing it to save the planet. They're doing it because the secondary market, people tend to, when there's a sell-off, Donald Trump tweets something and the market crashes, then everyone sells off ordinary bonds before they sell off the green bonds. Sort of makes sense, right? If you've got a free set, something that's associated with a free set of steak knives in your kitchen, you'll sell off the ordinary one before you sell off the one that's got the free set of steak knives.
Fair enough.
Now, what that means is they hold their price. And so whenever there's a downturn in bonds, green bonds hold their value. A secret about bond investors is they're defensive. Their first job is to ensure that the value of their assets is maintained. So if they have to pay out a whole lot of pensions, they've got the money.
Right.
So anything that holds its value in a better way than any other bonds is gold dust. And that is driving appetite, as they say in the market, which is including reduced rates.
So that's really interesting because that explains the concept of the green premium in a way that's logical and financial rather than just sentimental.
Absolutely. I mean, I wish sentiment was there, but there's a little bit of it in some markets, but it's primarily driven by hardheads. We've got hedge funds who play in this space. So all sorts of parties just are really working on the arbitrage between green and ordinary. Great. That's how markets can work well.
Fantastic. Now, that brings up another question, which I think is a question that a lot of people have, which is what is the difference between a green bond and a climate bond? Is there a difference?
There was at the beginning. There basically isn't now, which has been a pretty tough campaign over the last 12 years. When we started, I can remember me sitting down with a banker in New York, one of the large banks, who said to me, "Sure, this green bond stuff is fantastic. We're going to see probably $100 billion by the time we finish. It's going to be vast. $100 billion it's going to get to." And then he said, "But the climate stuff, that's just going to be about 10 billion of it, realistically, because the better stuff is going to be general green stuff, parks and water." I said, "Mate, you don't understand what's going on here. Climate is actually everything. Everything becomes substitute to climate. That's the first point. And also, this is going to be vast because asset owners are concerned about climate, and this is the perfect solution for them." And don't get me wrong, it's not a long-term solution for investors. I'm going to call it the starter pack. It gets them engaged. But in the meantime, this market has grown to 6 trillion and is basically focused on climate. Specifically, there's about 4.5 trillion of green bonds that are all climate bonds. And then there are sustainable bonds that are a bit of green and a bit of social. And then there are social bonds. But we now look at the social aspect as about climate resilience. In fact, we've done an extension of taxonomies now into adaptation resilience. We're explaining to people how stronger societies are absolutely critical if we're to survive the volatility, the severity of climate impact. And
that was actually one of the things I really did want to talk to you about, because in the last couple of years, the conversation has shifted. It used to be mitigation and adaptation, and all the money went to mitigation and not adaptation because bankers don't particularly like adaptation because it's very hard to financialize the returns. But at the same time, we're beginning to recognize that resilience, even regeneration when it comes to nature and farming and the food system, these are all incredibly important issues. As you say, it's this idea that, you have to have a robust and resilient society if you're going to be able to navigate volatility and uncertainty. But what does it actually mean? What does resilience mean to you? Because everybody seems to like labels. Everybody likes to have something they can just stick on there and say, right, we know what that is. I've ticked a box, I'm done. What is resilience? Why does it matter? You've talked about the fact that it's all there together, but why is resilience now becoming so important?
Well, first, let me just cover the issue of labels. Labels just make it easier for people. If I'm in a supermarket and I see fair trade coffee and I'm interested in fair trade, well, it just saves a whole lot of hassle, right? Someone else, as long as I trust the label.
So someone's done the work for you.
Correct. It's the journalist work. And that's why labels, that's how it works for investors. When someone does work, and there's a lot of protocols developed over the years, transparency, reporting protocols around it, and guidance, like taxonomies of sustainable finance, are basically shopping lists for the future. So we've managed to get a reasonably common approach globally to the shopping lists of the future that are climate related. That's one of the ways we've made sure the green is climate related. And it's worked, and it's made life easier for issuers and investors. But resilience, look, we're hitting climate impacts. We're hitting 1.5 degrees. We have to prepare. So in terms of the climate focus, it's a logical extension of making sure we invest for the future. Now, it's not about new investments where financial viability is complicated. It's actually about changing the procurement requirements for pretty well everything. Like if you think about water investments need to take into account changing rainfall patterns. Now, logical, right? You'd be surprised how often it's not thought through. Ports investments need to be prepared for changing sea level rises and storm surges, because remember, the key impact of climate change is volatility. Think crazy weather. And Singapore's already raised the levels of its ports to 6 meters. Every port's got to do that. So if you look, that's the physical infrastructure side of things. Cities need to be more heat resistant. Buildings have got to be naturally cooler and preferably cool enough that they can survive when the power goes off. In other words, you can't just rely on the aircon working all the time, because we have grid problems in severe heat as well. So the resilience, though, has to be more than just physical resilience. We now have acceptance that physical resilience is necessary. On the investment side, one of the reasons this works is because there is strong demand for green bonds of all kinds. And investors are saying, give me more. I can't find enough. Where's the pipeline? So we're expanding the conception in line with the science over time. We've added, for example, in the last few years, the conception of transition. Hard to abate sectors like steel industries going green and so on. And that's becoming to be accepted now. Now adding resilience, and it's working. We certified a bond from Tokyo a few weeks ago, 300 million euros issued in London. It was 7 times oversubscribed, the same as any green bond, exactly the same. And they got a price benefit out of it too. So we've established the idea. So as we slowly expand people's understanding, which requires proper science, proper evidence, we need to look at other aspects of surviving volatility. Volatility isn't just the floods or the droughts. It's also the social impact of those. It might be pandemics. It might be the collapse of societies and migration if we don't make the right investments up front. So there's a wide range of things that start coming into it, and that's the work we're doing at the moment, fleshing those out.
So, I mean, I love that idea because it does actually do the very thing we always say that isn't happening, which is step beyond individual silos and look at the interactions within an environment and what you need to fund and how. But are you seeing resilience and adaptation bonds scale in the same way that the more traditional climate bonds have done? Just because, as I say, because I have heard asset managers talk about the fact that with adaptation, well, there's no financial line associated with that benefit. So I don't understand how that turns into a bond, and they move on. What are the challenges?
Market has not been associated with a financial line for the investor for the specific investment. If a bank makes a loan to solar farms and then packages it up as a green bond for investors, the green bonds are getting a bank bond, which happens to go into solar farms. So this isn't project finance. This is refinancing an asset. Or if Vestas issues a bond for a wind production, you're taking a bet on Vestas, the company. You haven't got underlying exposure to wind farm. It's exactly the same in resilience. So Tokyo government that's issued a pure resilience bond, which is financing everything from huge tunnels underneath Tokyo that will soak up floodwaters to burying electricity lines that would otherwise be blown over and new severe typhoons that are coming through. It's a Tokyo government taxpayer that is ensuring the credibility, the financial credibility of the bond. The investor doesn't have any exposure to the electricity lines that are being knocked over. It's absurd. And why should it be? So if you start thinking in those terms, this becomes very easy. What you're going to get in the resilience space is a lot of governments like Tokyo, a lot of governments like the Netherlands that issued a 10 billion euro resilience bond a few years ago to finance coastal protection and so on, and corporations doing the same thing. And we will get to $3 trillion very quickly of resilience-rated bonds. Now, what we're saying is they're part of the climate universe. In pension fund land and insurance fund land, liquidity is everything. So we're saying actually keep it to one market, then you can trade as you need to, sell more easily. It's just a subset of the single market. It's not a different market. It's just a new set of criteria.
So that's back to the labels are there to be useful because they show that the work has already been done in identifying what's going on. But in the end, it's one big market that we're using to try and reallocate capital to help address the challenges we face, be they storm surges or heat or whatever might be. Okay.
Now, there is a Trojan horse aspect of this.
Okay, good. Tell me more.
So the fact that Tokyo has done a resilience bond highlights what Tokyo has done. Every other subnational government looks at this bond and says, what the hell is this thing? What do I need to do? It's actually setting a benchmark for what all governments need to do. And this is really important. So for those of us that are out there talking to government separately about what you need to do to address climate change, the fact that Tokyo raises money for it acts as a very significant attractor to other governments.
It's a wayfinder showing what's possible.
It's an education tool of significant import. And this links to the guidance about what qualifies, the taxonomies that we're putting out there, because it's saying to people, look, here's a list, here's a shopping list. This is the sort of stuff you've got to do around resilience. You can get a consultant to give you more detail if you like. But think of this as a minimum benchmark, like investment grade bonds, for example, rule sets. And that just makes it easier for one to get started. And that works in cities in India as much as it does in cities in the USA.
Excellent. So it pretty much is applicable everywhere. It's about getting people to recognize what's possible, the benefits of doing it, and where they can raise the money.
Exactly.
Fantastic. Well, that's a very good thing. I suppose there is one thing, though, because, again, talking about how quickly the market has scaled, is there a bottleneck in the amount of money going towards climate finance?
I don't see any shortage of money. My standard speech nowadays is we are awash with capital in this world. Yes, it pools in different places, but let's be very clear. There is no shortage of capital. All there is shortage of capital in different places for different tasks. And in fact, what happens in the global financial system is that capital pools badly in different places. In 2004 to 2007, it pooled in the US mortgage market for a bunch of macroeconomic reasons. And that led to too much liquidity and crazy behavior by the banks to try and soak up liquidity, etc. We're seeing a bit of that happening in the US at the moment, the AI market. So our challenge is not to create capital. Our challenge is not even to get capital interested in going green. Because the truth is, we asset owners and then fund managers are wanting to present central banks. One of the green bonds that was done recently, we had one central bank from Eastern Europe want to buy the whole lot. And they weren't given it. They were given 1/10 of it at the end. There's a significant demand among central banks. So all sorts of buyers are in this space. No problem with purchase. What we've got is a problem with supply.
Okay.
That is product manufacture that meets the needs and that is trusted to address climate change in a way the stakeholders, the relevant parties will trust them. That's really the job. So everywhere I go, it's sort of about the pipeline. Now, the pipeline's already pretty big. We did a report at COP which shows that there's coming through the pipeline over the next 10 years from existing issuers about $17.8 trillion of sustainable bonds. It's a pretty big size. The trouble is that in that 10-year space, we actually need to have about 100 trillion of issuance. So we're only nearly 20% of the way there. But it's not 5%, it's not 2%, it is 20%. That's a really good news. Now, how do we get more into this particular space? Well, one of the ways is encourage more issuers with more criteria. Such as the Metropolitan Governments of the world or the CAF, CAF, the Latin American Development Bank that issued a resilience bond in Belém, for example.
Yep.
We expect to see a lot more of that. We need more transition bonds coming out. We need more grid bonds. So we need to about quadruple grids and transmission lines around the world as we slowly become electrostates like China's becoming. And that's require a lot of investment, which is highly investable. We just need to bring it to market. So we took to governments, ministries of finance, about how they can speed up policy measures that will bring forward the investment pipeline that investors want to invest in.
Yeah.
Now, this is a gorgeous position to be in if you're a climate activist, because you're actually saying to governments, do more climate stuff and the money's going to come rushing at you, which is true.
You see, there is a thing that does come up, which is the lack of communication, for lack of a better phrase, between the finance community and climate activists. If you put an asset manager and a climate activist in a room together, they probably both think that they were doing the most to solve the climate issue and the other one was more of a problem than a solution. But trust and communication are such fundamental parts of this. One of the issues with transition bonds that's come up is that it makes a huge amount of sense to help people transition from fossil fuel dependence to non-fossil fuel dependence. That's just logical. Where it seems to get tricky is when that's often seen as a means even for fossil fuel companies to raise funds from the green bond market for transition, but they're still actually extracting fossil fuels. So how do we square that circle?
Well, there's a lot of, you actually haven't got much of that. There's not really a lot of fossil fuel company trying to raise the green bond. However, if a fossil fuel company builds a solar farm, it's still a solar farm. It's a green asset and it helps. And if they can get cheaper capital to build solar farms rather than oil plants, then they're probably going to build more solar farms because oil companies are really just engineers and finance people trying to make a buck. I remember this with Adani in particular in India. Was a huge owner of coal thermal power plants. They've actually built Adani Green, which is now the largest renewable energy developer in India, much larger than the thermal power plant division. Why? They make more money and they attract more capital off the green side of it. So it's easier. And that's how we have to make it work for the big companies, right? So I'm very happy if Total Energy issues a bond for a green investment of some kind, as long as it's properly green and as long as we've got some kind of the standard protocols to track the money and so on, go for it. All for it. We need to change this stuff. That's one of the ways we'll change them. There are other ways as well. But, if they make more money out of solar, they will change because they're just mercenary.
Yeah, no, I suppose we did touch on this earlier. This is about realigning the flow of capital so it goes towards the things that we want to see.
And remember that the flow of capital is managed in this society. It's things like energy policy or central bank policy that determine why things are more proper in one direction or less proper than another. Japan, for example, still has $1 trillion of fossil fuel subsidies in the system while it's desperately trying to green the system.
Yeah.
So there are artificial boosts to the wrong kind of investments going on all around the world. We've got to bear that in mind.
Yeah, well, I suppose that's the famous conversation about not even going as far as let's ban fossil fuels, which was the big debate at Belém, but actually, why don't we stop subsidizing it quite as much?
That's right. Exactly.
Because, that was agreed a very long time ago, but it's been almost impossible to get anywhere with that just for political reasons. But I think that's actually a really interesting question. I'll come back to you on that.
Tricky. Some of the subsidies are tricky. If you're in a country where the poor are depending on cheap petrol, I'm thinking of the Gilets jaunes in France, and you want to raise taxes on petrol without addressing transport for poorer workers, you're going to have social reaction. So it can be tricky.
That one does make sense to me. I was thinking more along the lines of, I can't remember the name of it, which I really should. I want to say Deepwater Horizon, which was the...
Yes.
Because bluntly, a lot of that was paid for with tax breaks and all sorts of things.
Yeah, absolutely. I mean, the US has got ridiculous boondoggles for fossil fuels.
I do think, though, you're absolutely right about paying attention to the detail of who it affects, because I do think there's a danger in a lot of what we talk about, whether it's fossil fuels or climate change or politics or whatever, there's no nuance. And actually different contexts sometimes require different solutions or different approaches. But I suppose I would love to know if there is something out there that you think is a really sensible, quick win, something in sustainable finance, something we could fund or some way of doing things that is hiding in plain sight but doesn't really get enough attention. Or conversely, if there's something that gets loads of attention but is just very fashionable and maybe we should do other things.
Well, most of my answers there will be in policy measures.
Okay.
I'll give you one example, Felicia. Buildings consume a lot of energy and heat and fossil fuels as a result, especially when you've got a mixed grid. Getting low energy buildings, or let's call them zero performance or net zero buildings, is really actually quite a high priority, as the International Energy Agency has been arguing for 15 years now. We could do this very, very quickly. Imagine that every commercial building in London had a maximum height of X. It can be lower than what it is now. But if they made a net zero building, which is eminently doable, engineers like Arup can show them how, they get an extra 3 stories or 4 stories. Simple height.
Yeah, they'd love it.
Every developer in the world will be running because they all want square meterage.
Yeah.
And that can work in every single city in the world, especially in emerging markets where we have massive uplift of buildings going on at the moment.
Yeah.
That's a very simple thing to do. No cost to anyone. And we would get really low, dramatically reduce energy uses in cities very quickly. And if you retrofit, maybe you get a chance to build an extra 3 stories on top.
Yeah. I really like that as an idea, and it actually fits really neatly with this idea about performance standards and just setting a baseline for what should be done, because I know the EU is reviewing its procurement policies. That's 11% of the EU's GDP. If you put low carbon or nature positive or whatever, even just higher performance, lower energy consumption standards in that, you could transform the market. Fast track it, yeah.
You know, for most developers, their biggest problem for them is the cost of capital while they wait to get approvals and the cost of, say, owning the land they can't use. If you can have differentiated fast track approval, you've still got to go through all the hoops, but you have a special team that really works hard to get it through if it's green. That would be worth gold to developers.
Yeah. So it's, again, in the same way of thinking about who it affects, you have to think about who wants what benefit the most. Because if you can guarantee it's green, well, then that's a fantastic thing to do.
And for that, you need those rules that I mentioned before.
Well, this is what I wanted to come back to. Yeah. So how can we know that these things are green? How are they measured? How are they managed?
So the way we've tackled that problem is we've brought together domain experts in each area to look at what the rules should be. Now, the rules have got to be pretty simple because bankers, sometimes some of the smartest people in the world, do not understand environment and ecology. They often think they do, but they don't. So we need to have relatively simple rules of bankers suitable for a tick on Bloomberg. So when you're trading a bond, you know quickly whether it's a preferential green bond or not. Now, but to do that can be hellishly complicated, like all standards work, right? It's complicated in the work until you actually come up with a solution. So we bring together these technical expert groups of people around the world, technical work groups, people around the world with specialists in area, academics, think tanks, sometimes government officials, to talk through the issues and come up with rule sets. And that's what we've also done in the European taxonomy and other taxonomies around the world for governments. And then we try that out on industry groups to make sure vague is practicable, and that becomes a rule set. So there's an established process for doing this, which is about channeling the science. The mantra you will hear is science-based. This is not the same as the policy of ministries and governments, which tend to be they've already made decisions for various reasons, so on. We're deliberately saying it's got to be based on the science. Science still needs convening of people to talk it through. And that's working. So now we have 50 countries around the world, including the European Union, calling it a country for a moment, that have this guidance called taxonomies of sustainable finance, which are really just shopping lists of stuff that you've got to do to address climate change.
So I suppose, is there any other mechanism that you look at or innovation that you see that we should be focusing on as well as green bonds, as well as climate bonds? Or do we actually just have to make this market bigger and more liquid and devote effort in policy and technology and innovation to provide the pipeline?
Well, remember what I started off saying with this story. It's not about creating a market, but the bigger and still trusted the market can be, the more it'll be attractive to more and more of it. It becomes a dominant piece of the puzzle. And just for diversification reasons, everyone's got to invest in it. So we're in that kind of point in history at the moment. But the real issue is then how governments respond and the kind of extra cities. And we're starting to see that. We're now seeing the rollout of all sorts of schemes to promote more green finance. We have the European Commission's got a green bonds hub, for example. They provide technical assistance for African countries and Latin American countries who do more green bonds. So that's all really cool. Guarantees are really important. For a lot of poorer countries, the cost of capital is prohibitive. Differentiated guarantees, especially for green, reduces the cost of capital and makes it easier to do it. So think of it this way. First, we've got to know everywhere what qualifies. Well, you and I need to know that. If you walk into a supermarket, I wish someone would just put a label on everything saying this is climate consistent and this isn't. So you can buy it, but hey, understand, et cetera, et cetera. I think everyone should know that when they walk into a subway, that's a climate investment because electric transport is efficient, much more so than a Tesla, et cetera, et cetera. That's what the taxonomy does. And then you preference it. Everything you can to make it easier for green stuff to go becomes the priority. So that zero carbon buildings, extra stories, fast-tracking investment, and guarantees and incentives for green finance, including government to government, that is north to south. And if we do that, we can actually go a long way really quickly. But that public policy stuff, which is what a government in Kenya or a government in France does to make sure everything takes advantage of this market, is the real thing we're aiming for. We're trying to get those institutional investors to say, France or, Kenya, I really want more green stuff. If only you'd build more railways and get rid of the petrol plants and all that. I mean, Kenya's already very green, by the way, but you get the idea.
Yeah.
And that's really what we're at now.
So, the one question that obviously has to be asked with what's going on in the US is how much of a concern is that for the global bond markets?
It's a real bummer for the US and the US economy that's going to be left behind. I think it's going to consign General Motors and Ford to the dustbin of history in terms of car companies, for example. And they already only produce about a third as many cars as Toyota and VW and half as many as BYD, I think it is. Some crazy figure. But the main thing I'd say is that in green bonds are down domestically in the US, but in China, they're up 50% this year. And that's basically what's going on. When I'm in Asia, everyone's just talking about what they're doing. No one's even talking about the US. It's not even the radar. In the US, it's unfortunate and it's tough for the market, but institutional investors in the US are not talking about climate change, are not talking about diversity and inclusion, but they have not changed their actual policies.
So that was actually one thing I was wondering, because I have seen the difference that in Asia, everyone is talking about what they're doing, but no one's not doing it. And as you say, because of the fact that resilience is important, and if you want long-term return, you have to have something that will enable you to manage that uncertainty or defend against it. What do you think of the EU's position with the simplification? Do you think it really is just the growth agenda and a desire to simplify reporting? Or does it feel like the EU's kind of following in the footsteps of the US with the pushback against sustainability and climate regulation?
No, simplification agenda is just what it says. Simplification agenda, frankly, it was overdue. We'd really complicated things too much. Now, every time there's a big change, there's a chance that people grab it for their own purposes. That's always a risk. But at least in terms of Ursula von der Leyen and Valdis Dombrovskis's perspective, they are absolutely sticking to their Green Deal climate goals. but they're looking about ways they can make it easier for it to happen. And that's a reasonable thing to do. I mean, we've got some
Fantastic.
other reasons to be sticking to green in Europe. The security agenda, for example. We've learned we can't trust Russia. We've also learned we cannot trust the US, which we're getting a lot of gas from. And Qatar we can trust, but Qatar got bombed by the Israelis recently. It's not exactly 100% secure.
Yeah.
So we have some challenges, and Europe could go 100% renewable with the support of North African countries exporting clean energy and DC lines across the Mediterranean and more, and a whole lot of things internally. So this is a reason to keep up with the Green Deal, defense security. And we're going to see that discussion play out a lot more in the coming year.
Well, I look forward to that. Now, I suppose my last question to you is there anything I haven't asked you about that I should have done?
I think, Felicia, the question that you haven't asked me about is about young people
Yeah.
and getting in the industry, which is, of course, is part of our background together in the universities and so on. And I'm going to frame it this way. The last couple of years, I've been in these amazing discussions with people who've entered the industry the last 10 years or 5 years, work in sustainability, and it's just a norm. And they're not talking about whether you should do it. They're just saying about how to grow it and all that sort of stuff. And that's what happens when you establish different ideas as a norm. Where 15 years ago, green finance was a bizarre outlier idea. And now it's a norm, especially when there's $9 trillion. This is how the world is going to change. We're going to normalize key activities. We've got to shoot for mainstream, and then job opportunities will come. So for a young person, I'm going to say, this is the place to work, because there is no doubt where this is all going. We're taking over the world with a very simple idea, which is an idea that we can do well by doing good. And not doing good for sentimental reasons, but doing good because it reduces risk of default going forward and improves long-term outcomes. And we can link it to amplification at a policy level. And we are doing that. Look at how China's new economic plan the last 10 years has changed the economics of electric vehicles and solar and wind.
Yeah.
That's an example of strong state action. The future is green. There is no doubt about it. And no amount of huffing and puffing can change that.
Sean, I've got to say that is the perfect line to end on. Thank you so much for joining us today. I've really enjoyed talking to you. And I hope we will be able to stay in touch. To our listeners, I hope you learned something useful. I hope you want to continue to work in the area. And let's be honest, let's get green finance going and make it normal for everything.
Thank you for having me, Felicia.